So for better or worse, a few years ago, CMHC put out a new program called MLI Select. And MLI literally stands for Mortgage Loan Insurance. So I'm just going to refer to it as Select. But CMHC put out this program to help builders with multifamily stuff that would be purpose-built rentals. And they had three different categories that you had to try and achieve. So one was affordability, because there was a big push in terms of getting affordable rental product on the market. The other was accessibility, and they worked with the Rick Hansen Foundation to put together some guidelines for accessibility, which is great. And the other is energy efficiency. So Kingwell, we picked up on the program right away because we were already building net zero type homes, net zero ready homes, and we thought we could transfer that knowledge and design over to some of the multifamily stuff that we were looking to do. Every so often, though, as CMHC is apt to do, what they'll put together is some comprehensive changes just to redirect the portfolio, make sure they're not overweight in any one portion of those three categories. So what we saw a couple of years ago was a big shift away from energy efficiency back to the affordability component that they really wanted to focus on in the beginning anyway. So when we look at that and we talk to clients, whether we're doing the construction for our own projects or if we're doing it for other investors, we really look at, can we take advantage of this program today? That and the move toward HST flow through, which is great as well. Where you're saving that 13% straight out of the gate. It really is a tough argument to not build purpose-built rental right now. The only thing that is holding people back, in my belief, is costs have elevated, and some of the delays that we're seeing are that exact stuff is time is money. So as we see some delays in getting stuff going, it becomes cost prohibitive to build some of these things. And where people are looking at really taking advantage of that affordability component is they'll have there's different points for different thresholds, but if you can get to 100 points, that's the maximum. You're looking at 25% of the units are deemed affordable. And when you look at affordability, you have to go by municipality by municipality. And it's not always, that easy to piece together exactly what they mean by affordable rent. So what they talk about is that it would be 30% or less than the median renter's income. So some people took that to mean, okay, well, if the median income in an area is, call it $100,000, then as long as they're $30,000 a year or less in rent, so $2,500 a month or less, but it's median renter income. So it's a significantly less number. And in that case that I just provided, it'd be actually about half. So, as we look at that, there's lots of different ways to hit the different criteria for new construction. And one of the reasons why we really took note of this is that at the back end, so once construction is complete and you're done building and looking to convert it then to just a cash flowing asset, if it meets the criteria, and that well in advance, But if it meets that criteria for the MLI Select program, you can finance up to 95% of the value. And to me, it's one of the only ways that you can get, basically all of your original capital back out and make money on investments that you're not, you have no equity in anymore. So it's a great opportunity in that respect. Also, if you hit 100 points, you can amortize it for up to 50 years. So coupled with having no money in it, having this extended amortization, we were looking at, if we were 75% loan to value of a standard mortgage, or even up to 95% of what the expected value on the back end was, with the extended amortization, and because it's insured, lower interest rates, your cash flow is even that much better, and you've got no equity remaining in the property. So that to me is a tremendous opportunity, and I hope is not one that investors overlook. I go back, 20 years ago when we were doing insured rentals, like one-off rentals. We were able to do like 95 or even 100% financing on some of these rentals, and potential landlords were very shy, and CMHC, they hit their targets, and then they altered the programs and actually did away with insured rentals, unless they were multi-res completely. But I really hope that investors take a good hard look at this and don't miss the opportunity that's on their doorstep right now, because there are condo projects that were originally for sale that may no longer fit with what the metrics were when the land was being developed, that you may be able to pick up on a great price. I was at a presentation the other day, and it was actually Skyline. I don't know if they're using the Select program or not, but they were raising capital for a product out of Brampton. And one of the interesting things there was that program, they partnered up with someone who was originally going to build them and sell them as condo apartments. And obviously the numbers in Brampton didn't work. That whoever it was that was looking to build them out initially said, you know what, we need to partner up with somebody who wants to do purpose-built rentals. So it was an interesting thing to see that really the market is adjusting in that direction. It may not for long. The pendulum never stops in the middle is one of my favorite sayings. So, it was very weighted to the owner-occupied side of construction, and now it's swung to the rental side. Well, I don't know when the pendulum is going to swing back, but right now, it's certainly my advice to look at projects that are out there that it would fit the purpose-built rental side of things. And if there's money enough to add a few affordable units, then all of a sudden that Select program works, and we can really make a go of it and help our potential investors start to finish with the design, application, getting right through to make sure that at the back end, when they're finalizing everything and they've got these units rented, that they're able to pull out whatever they are comfortable with. So maybe it's not 95%, maybe they just want to take out 85 or whatever it is, But if their cost is less than that, and they're literally able to get all of their original capital back out, what a great way to then we'll say 10x your portfolio. So anyway, just food for thought that I thought I'd share. But no, we've been working with a few different clients on this, and we're happy to take on a few more. Specifically, if you're in and around the Guelph, Kitchener-Waterloo, Cambridge area, or maybe you're up Port Elgin, Southampton way, and so we'd certainly love to expand our construction portfolio up there. So happy to help. Give us a shout, and thanks again.